Good evening, everybody out there in YouTube land. It's Kaiser Pineapple, y'all. And boy, howdy, we are coming at you live with some breaking news. All right, folks, it is a bit of a switch up. I know we usually do Edge Reality on Wednesday nights, but there is a lot of news that is breaking fast and furious, and well, we need to go ahead and just get this all covered and out of the way really quick because I don't want to be late to this one. This is a lot of stuff going on that just kind of all happened really within the last probably hour or so. So yeah, it's been a wild ride. Hey, what's going on, Ms. Gay Griff? Pineapple flying up into the distance. Yeah, that was by design. It was a good time. So, all right, let me real quick. I'm going to throw this out to the Twitters. I know, X, whatever the deal is these days, whatever. All right, get that there. The Marvels, woes, and the SAG-AFTRA strike ends. Yeah, I kind of ran out of time to do prep work ahead of time for this, so I'm having to kind of do things in real time. Hope y'all can kind of forgive me on that one. All right. There we go. Tweet is live on my page there, so feel free to go ahead and retweet that. Send it all out there. And yeah, that way we can go ahead and get things rolling. What is going on, Dave, my good buddy? Glad I got a notification for this. Yeah. So yeah, it has been a bit of an interesting and frankly wild ride. Last probably couple of hours. And I would just like to say that it has been interesting to say the least. So after all this, let's just get straight into the breaking news right now and let's just get to it. So first things first, we got to talk about is, of course, the long-awaited end to the SAG-AFTRA strike. Yep, folks, it is over. The horrors have ended. We can now all go to a place of healing. The SAG strike has ended. Yes, it's finally over. And now that means that, that means that the actors can go out there, do their press junkets, open their mouths all that they want. Oh, that means that they can talk. Yeah, I forgot about that part. Oh, wait, no, I didn't, because that means a hell of a lot more of monetizing on their stupidity for me. Oh, yeah. I'm going to have so many more videos now that the SAG-AFTRA strike is over. And, you know, I really like the fact that Gary over at Nerdrotic refers to it as the Film Actors Guild. If you get the joke in there, good on you, because I'm not going to repeat it. Oh, goodness. Sound effects are on point. Well, I try. I mean, don't do as much of the shock jock radio sound as I used to, but, well, I used to try and keep everybody entertained. Anyway, so yeah, as I mentioned there, yeah, the Film Actors Guild, supposed to be Screen Actors Guild, SAG-AFTRA. Yeah, Ms. K. Griff, Yeah, so just take the first letter of each of those words, because SAG is SAG, and yeah, just transpose the letters, and it's a joke. It's a horribly inappropriate joke that would probably get me yeeted, but oh well. And JKD Buck, darn strike is over. Oh, Buck, my buddy, I'm just saying, this could not make me happier that the I almost said it, that the actors are no longer on strike, because this means that they are free and clear to flap their gums continually all that they want. And as somebody who is actually able to, do a YouTube show and do content like this where I'm talking about what is going on in the world of entertainment, this is a huge, huge boon in my favor, because it means that I get to cover all their stupidity. Buck says, fudge them all. They are worthless as a screen door on a chicken or something. Screen door in a submarine. Yeah, I know what you're talking about. Yep. And totally, I get it, man. I'm right there with you. But as somebody who's trying to make hay on all of their stupidity, this just makes me happy that they can now go out there and do all kinds of fun stuff and say all the stuff that, well, up to now they couldn't. So, I'm feeling the love tonight. I'm feeling good. There's been a lot of things today. Look, the news right now could not be worse for Disney, for Marvel, and for Hollywood right now. I mean, sure, the Screen Actors Guild, if you look at it from one perspective, sounds like a good thing, but let me be completely honest. For Hollywood, it's a terrible thing, because we were all happy not hearing actors continually talking, except for those of us trying to make a living off of it. And yeah, I was literally watching the Disney earnings call when the word went out that the strike was over, and my brain did a complete what? Yeah, it was definitely quite a surprise to me there. But apparently it's for a 3-year deal, 3-year contract. It has yet to be ratified, so this is not final yet. But let's get into it. All right. Let's begin our information there. All right. After 118 days of the Actors Guild being out on strike, SAG-AFTRA and the studios on Wednesday reached a tentative deal on a new contract that could see Hollywood up and running within a few weeks. Again, tentative deal. That is a very, very important detail right there. Because, okay, come on. Yeah, because being a tentative deal means that this hasn't been ratified yet. It means that they still have to go ahead, go through some information, and kind of make sure that they've got all their ducks in a row. Ms. Kager says, how long has the strike been going on? I can't remember. So yeah, 118 days. So yeah, this started back, I think, in July, I want to say, with the strike. And so the WGA went on strike. I think they struck for like 140 days or something, 147 days. And then SAG-AFTRA immediately started going on strike after that, because of some of the things that the studios were talking about with AI and some of their talks about what's going on with pay and streaming and everything. There's a lot of variables to it. So yeah, specific details of the deal are expected to be revealed when the agreement goes to the board on Friday. Okay. WGA Wine Gluttons Anonymous. Yeah, just about. I'll be completely honest. I mean, although I'm pretty sure a lot of these people have probably missed their, latest couple months payment on their boats. But, Meanwhile, the guys like the gaffers, the makeup people, the prop designers, the people that are on the bottom tier, like actually the stage crews, all the other people that have basically been languishing under the fact that the actors aren't acting, the writers aren't writing. The people that were actually involved in production have been getting screwed for the last 140 odd days. So just want to make sure I make a quick note there that while all these people were arguing and whatnot, none of these people were allowed to actually work. Hey, what's going on, Rose? Hi, y'all. Sorry I'm late. Have like 3 or 4 live, and oh God, I am so sorry. Oh, I'm sorry. So sorry to hear that. Sorry, I'll take that off the screen. And say I hope things get better. Say, don't worry, we got things under control here. So yeah, we appreciate you. Thank you so much for stopping in, Rose. I hope things get going better for you. I seriously do. All right. Coming just less than 3 months after the Writers Guild members overwhelmingly ratified their own agreement with the Elite Alliance of Motion Picture and Television Association, SAG-AFTRA's deal is the culmination of the latest round of renewed negotiations that began on October 24th. Indicating the seriousness of the stakes of the negotiations, Netflix's Ted Sarandos, Disney's Bob Iger, NBC Universal's Donna Langley, and Warner Brothers Discovery's David Zaslav frequently directly participated in the talks. Okay, so something I do want to make a note of here. So something that's not being talked about much, and even Deadline kind of missed this one. This is actually kind of hilarious. I gotta grab a quick headline here. So there was another story I grabbed just before this. Okay, there it is. So what's not being talked about in this article is that, only a few hours ago, 4 hours ago, studios give SAG-AFTRA a deadline to make a deal to end strike and with TV and summer movie season in peril. Yeah, so right now, everybody's screwed for the winter and spring for for movies and TV and everything right now. Even if stuff gets back into production and things go like immediately and start immediately getting in there. Up until basically spring, there's not going to be any content, which is why you've been seeing a lot of movies and things getting pulled from this year and getting moved to next year, especially in that spring, summer, that spring and late winter kind of area, because a lot of things have basically been shut down. They don't have any content to put out there, so they're spacing out a lot of their releases to try and cover a lot of that. So get ready for a lot of nothing in the box office in the early part of the year, and they're going to try and shove stuff out there. So it's going to be interesting to watch. So this only dropped 4 hours ago, where they basically gave them a line in the sand, gave them a deadline, and said, "Okay, we're tired of this. We're tired of your shit. Reach an agreement already. We're giving you only like a few days to make to finally come to an agreement, and we're just gonna say peace." Well, guess what? 3 hours after that, apparently they came to a decision, and now the strike is over. Because at hour 4 now it's actually reporting. What's going on, Wolfkinder? Hey, how you doing, buddy? Hey, Kaiser. There we go. So, that is the most recent and up-to-date breaking news there. It still surprises me that it only took them a little over 3 hours to come to an agreement after the studios literally just gave them an ultimatum, like saying, hey, figure this shit out, or, peace, we're gone. Hey, Traveling Fools, what's going on, buddy? Good to see you. All right. And even the Hollywood Reporter getting in over here. So the work stoppage will end 12:01 a.m. on Thursday, according to this. Again, that's provided that all the ratification goes through, which will probably take a few days. Not sure if we're going to see any kind of like mass return to work yet. Probably could still be another week or two on that. Excuse me. All right. This is all breaking like really within the last hour. So we're trying to get into this. And Lamont Smalls, hey, I don't think I've seen you around before. Good to see you. Thank you for joining in. Deadline also uploaded about how most new broadcast shows would move to 24 to 25, including the new Matlock. Interesting. Okay, I'm going to have to check that out. Thank you very much there, Lamont. I appreciate that a lot. That's awesome. Matter of fact, I'm going to quickly dig for that. Bingo. All right, folks. Everybody say a very big thank you to Lamont Smalls in chat for dropping that tidbit, because we got more breaking news. All right, so picking that up. So most new broadcast scripted series moving to 24 to 25 season due to strike-related production delays. This was only 4 hours ago. Wow. Say back in May, 2 weeks into the WGA strike, ABC picked up one new scripted series for the 23-24. I think I'm supposed to say 23-24. It says 23-34 season. Drew Goddard's High Potential, starring Caitlin Olsen, in late September, 2 days after the end of the WGA strike. The high-profile series was pushed to fall 2024 launch. Okay. Let's see. Additionally, let's see. Here we go. I hear NBC and Fox are each expected to push both of their upcoming new scripted series originally targeted for this coming mid-season into 24 to 25. That includes NBC Network's comedy St. Denis Medical, starring Wendy McClendon Covey, and medical drama Dr. Wolf, headlined by Zachary Quinto, as well as Fox's medical drama Doc and lifeguard drama Rescue High Surf. Additionally, two of CBS's new series drama Matlock, headlined by Kathy Bates, and comedy Papa's House, starring Devon Wayans and Damon Wayans and Damon Wayans Jr. are headed this next season, I hear. According to sources, The Good Wife spinoff Elsbeth, starring Carrie Preston, and Tracker, toplined by Justin Hartley, remain on track for mid-season. Okay. But that is the most up-to-date information we've got right there on that. So yeah, we're going to be getting some shows, but a lot of them are getting pushed back to 2024, 2025. All things considered, after the strike couldn't have come at a worse time for Hollywood. I mean, for us, it was kind of just hilarious to not have to listen to Hollywood for a couple of months, but that's just me. Ms. K-Griff says, I really only went to the movies for the popcorn anyway. Now I just make my own from home for much cheaper. Win-win. Yeah, I'm not kidding. I went and saw a movie. So back in September, they had the release of Satoshi Kon's I think it was the 25th anniversary of Perfect Blue, his movie. And I went there. I think I was one of less than a dozen people in the theater. It was a matinee. It was on a Sunday. I showed up, and of course I paid almost $20 for a ticket at a matinee. I'm like, holy crap, that's ridiculous. And then I go to get a bucket of popcorn. The bucket of popcorn cost me $18.50. I'm like, Jesus Christ, people. Yeah, I could buy enough popcorn to basically fill my living room for that much. Oh, goodness. Yeah, if I made it at home. But yeah, that's where movie theaters anymore make their money, is friggin' concessions. All right. So, getting on to the big story right now. Let's see. Oh, wait, I saw a new comment just came in. I took the tot to the Paw Patrol movie with only one other family there. Not bad for a first movie experience, but won't be doing that often. Yeah. My kid is 2, so obviously going to the movie theater is out of the question right now. But yeah. Oh my goodness. All right, so going on to the big story today, Disney and their earnings call with investors. We've got the CBC 15-minute pregame interview that it was a pre-recorded that Bob Iger did before the call. Then we have the full call that we are going to listen to in its entirety. And then we're going to kind of look into some of the other news that's going about. So hopefully try and cap this off at maybe a 2-hour show at like top end, try to anyway. Because I'm going to have to basically take all these stories, I'm going to have to compress them into some shorter videos that I'm going to be putting out tomorrow. But yeah, you guys get to watch it live. All right. And we're going to definitely be going way more in depth on this. Mine's 3 was an experience. Yeah, funny. Yeah. Okay. So let's just go ahead and get to this here. So let's just hear what old Bobby Iger had to say for himself on this CNBC interview. So I am gonna nudge the playback speed to 1.25, just so that way try to avoid some of the issues. Let's see here. All right.
So I want to start off with a direct-to-consumer business. You reiterated that you're on track to hit profitability as planned, but a big beat on subscribers. You also recently just raised prices. And I'm wondering if you expect that subscriber growth to be able to continue.
Well, we do expect subscriber growth to continue, but we're mostly focused now on delivering profitability by the end of fiscal 24. We had a great quarter, as you just noted, adding 7 million core Disney Plus subs. That was really the result of great content, particularly 3 strong movies, Guardians of the Galaxy 3, Elemental, and Little Mermaid. Disney Plus is proving to be extremely...
I'm sorry, did you just say you had strong showings for Guardians 3, Little Mermaid, Elemental, and I'm assuming Indy 5 is going to be the next movie that he mentions in that list, but hold the hell up. The strongest showing out of all those was Guardians 3, and if the numbers are any guess, that movie probably only just broke even. Bob, is there something you'd like to tell us?
You are fake news.
Yamaha Biker, what's going on? Hey, Kaisers, you sound better, not so brains zombie-like. Yeah, brains. Trust me, I was feeling it there last week. So, voice is still actually an octave or 2 deeper than it usually is. So, that's kind of nice, but otherwise, yeah, it's I'm doing a whole lot better. So yeah, here we go. Let's get back to this.
Popular and in demand, and we feel very bullish about its future.
So what is the future of your
bullish? You're going to hear that word a lot,
especially given the fact that you're about to, or you're in the process of buying out the remainder of Hulu that Comcast, CNBC's parent company, currently owns. And how much do you expect to have to pay over that base level that you already negotiated for that remainder of Hulu?
Well, first of all, as you know, there's a floor price, which is obviously public, stated.
Wrong.
We'll be writing them a check for that actually pretty soon. There will be an evaluation process that is dictated by the agreement that we reached with them a few years ago. I'm not going to say much more about that process, except, we expect it will be fair, and ultimately objective, and we're not concerned about the price that we will end up paying. It's a great step for the company from a strategic perspective in that it gives us an opportunity to further connect the dots between Disney Plus and Hulu, and ultimately offer even a three-play or a triple bundle with ESPN. There's three great sets of streaming assets, and in December, we will launch in beta form a combined Disney Plus and Hulu app. And then in sometime, probably in late March of calendar 24, excuse me, it'll launch basically out of beta. We feel great about it because the combination will give us an ability to essentially lower customer acquisition costs, reduce marketing, hopefully reduce churn, and most importantly, create more engagement. And that's great for advertisers. As you know, we have advertiser-supported subscriptions for both Disney Plus and Hulu. Actually, it's quite a bargain. You'll be able to, if you're a Disney Plus subscriber, you'll be able to upsell to Hulu for $2 more with advertising, and vice versa for Disney Plus. So this is all a great step for us.
And it seems like there's a
Oh, good. More upselling. Yeah, because that's exactly what everybody needs is more costs associated with everything that they're doing nowadays. Okay. Sure. More money. I mean, sure, you guys aren't going to actually, really focus on upping your quality at all, but, you're going to make us pay more out the butt. So, progress, right?
a big pressure, not a big push, not just from Disney, but from these other streamers as well, to really push subscribers to the ad-supported version of their services. How important is ad-supported going to be, and what kind of growth are you seeing in streaming advertising versus linear advertising? Because we've seen, and even in this quarter, linear advertising is really struggling. Well,
we can talk about both. First of all, we believe that the advertiser-supported streaming services, not just in the U.S., but in other markets, notably in EMEA, will be important growth initiatives for the company. In fact, in Disney Plus, we just implemented some really robust advertiser targeting tools that are already working and will help us obviously grow advertising. By the way, speaking of advertising, addressable advertising is very strong. And since you raised it, so is sports, by the way. I would say in linear, it's actually a little bit better than it had been. Overall, we've seen some improvement in general in advertising. It doesn't mean we don't have more improvement ahead. We actually believe we do. But for instance, technology sector has been a bit soft, but advertising looms large for us. And the combination of Hulu and Disney Plus advertiser supported is a great opportunity for us to grow the advertiser supported side of our streaming business.
And just to make sure to really hit the point on the linear business, you're seeing a strengthening market there, or what's your outlook for Q4?
Linear is better than many people.
Yeah, I agree. Sweat soy.
It doesn't mean it's great, but we've seen some improvement.
I want to make sure to hit on ESPN before we return to linear. You mentioned sports. Given the results that were broken out this quarter, the 15% increase in operating income for ESPN, what do these numbers indicate about the type of partnership you're looking for ESPN and when that might happen?
And I noted you mentioned that ESPN was up in the quarter and thus up in the fiscal year. It's actually up in operating income and in revenue in 22 and in.
Hey, real quick, say Christine Fortunato. Hey, how you doing there, Christine? Good to see you. Welcome to the show.
23. So great trajectory. And the ratings are actually very strong too. ESPN had one of the strongest years ratings wise, I think in the last 4 or 5 years in 23. That's a great thing. We obviously are planning to take ESPN out on a direct-to-consumer basis. We feel great about that. We believe we have an opportunity to strengthen that hand even more by bringing in 1 or 2 strategic partners that can add either marketing support, technology support, or possibly content support. Why not go out with a stronger hand, for instance? And that's what we've been considering. We've been in discussions with a number of entities. I don't have anything specific to tell you right now, except I think you can expect us to elaborate more on that sometime in the near future.
So there's been an expectation that this direct-to-consumer version of the flagship product will launch by 2025. Is that right?
We've not said specifically what date. We were targeting 2025. It won't be long. It won't be later than that. And again, we're working hard to make sure that we've got the building blocks in place to see to it that when we bring it out direct to consumer, that it is very successful. And we feel great about that, but we have an opportunity to consider some strategic partnerships that I think will make the transition even more successful.
Wrong. The NBA rights are the next sports rights that are up for grabs. How essential is it for ESPN to have those rights, and how problematic is it that you have these big tech companies pushing up the prices?
Well, I'm not going to comment about the negotiation at all, except to say I've said before, the NBA is very important to ESPN, has been for a long long time. I should note that ESPN is important to the NBA too. We bring to not just the NBA, but to other sports organizations a level of support, engagement with audiences, not just on linear television, but in podcasts and on radio and online and in apps, and I could go on and on. That's quite valuable to these sports organizations, and I don't think that should be discounted.
Well, we'll have to keep an eye on that one. I want to make sure we talk about the linear TV business, because the last time you were on CNBC with my colleague David Faber, you indicated you were exploring selling those linear TV assets. Since then, Disney was in a battle with Charter about what the future of
the Charter deal. Here we go.
Should look like, and Charter really pushed to bundle streaming rights with digital. How did that battle and the resolution of that change the way you're thinking about potentially selling these assets?
Well, first of all, I think what I said on that in that.
Real quick there, I wanted to jump in. Say, Christine says, I got 90 subscribers. Is that good? Hey, that is definitely good. That is definitely good. Keep at it. Yamaha says, every time I see his name, all I can think of is, it's Igel. All right. All
That
right.
interview was that I think we were considering a number of options, or everything was on the table, or something along those lines. And I understand how that was interpreted, and it is what it is. We have been considering various strategic options for each of our networks, not necessarily all together, but each of them. We do that as a matter of course for all of our assets, because we're aiming to increase shareholder value, obviously. But it's interesting because while we've been actually taking a look at the linear networks, we have uncovered a number of really interesting opportunities to reduce costs and improve the business. And in fact, you have to look at the business in terms of its strategic value to the company too. Not only its financial value, and by the way, it is profitable still for the company, but it provides a lot of strategic support for ESPN. There are a number of sports shows on ABC, for instance, for ESPN. We also bundle with the distributors, ESPN and those linear assets. And it's also those linear assets are very valuable for streaming, Hulu and Disney+. So we are looking in an open-minded way, but that shouldn't in any way suggest that anything is imminent. It should suggest that as part of our ongoing process, we're very, very realistic about the marketplace and the future of those assets, but we also are very mindful of their value to the company today and possibly into the future. And the Charter deal, to answer your question, didn't really change our opinion about it. Like, that was a great deal for us. I think it was also a very good deal for Charter. It did enable us to reduce the number of channels that we were distributing through Charter, while also giving us some great distribution for our streaming assets, notably Disney+. So kind of, I'll call it a win-win for us in that regard, and a real balance between traditional linear media and new media or streaming for us. But I don't think it really changed our outlook about the business.
But does that mean that, given that you're selling effectively a smaller bundle of channels to Charter, that ultimately you'll have to shut down some of those channels? And do you think other distribution deals will follow in the same path as Charter's?
Well, first of all, our core channels were part of the distribution deal. So when we talk about possibly shutting channels down, we have a lot of channels. I've argued for a long time, possibly too many. I think that's true actually for the industry. Over time, with the growth of cable, a number of channels were created. I'm not sure that serves the distributor or the consumer that well, but that's maybe for another time. But I like the fact that we're focused on fewer channels, and I think I obviously love the fact that we were able to bundle a very, very core future asset for the company, Disney+, into that deal.
You said that you're looking at all of your assets. Do you have plans to sell your India assets, India Hotstar assets? Any update there?
I don't have an update. I'd say the same thing about them that I said about our linear networks. We're looking in an open-minded way. We like being in business in India. We'd love to be able to strengthen our hand. I can't at this point predict where that will end up.
I want to ask you about Nelson Peltz. The stock is down 24% since Nelson Peltz declared the proxy fight over. He indicated, and he has teamed up with Ike Perlmutter.
Okay, here's the big one. She just mentioned Ike Perlmutter. Oh, yeah. This is the guy who is trying to push a hostile takeover of Disney to unseat Bob. Let's watch Bob's reaction.
Who formerly ran Marvel, that he is perhaps preparing for more activist action against Disney. Have you heard from him?
I had a call from him, but I must say I don't have specifics about what Nelson is really after or what he will ask for. I will say that, as is the case, has been the case in the past, the management and the board is always willing to listen to what shareholders have to say. We're in lockstep with the board in terms of our opportunities and our challenges and our strategic direction. We all feel very optimistic about the future of the company. I don't have anything more to add really about that.
Okay, hold up. Let's back this up. Watch Bob's face.
I had a call from him, but
Okay. Suddenly, he's looking down and to the left, and he will not make eye contact with the camera whenever he's talking about Nelson Peltz. This is a man who does not want to talk about this and whose brain just did a collective. Yeah. Oh, I love it. Hey, what's going on, Jude? Good to see you. Good to see you. And say, JKD Buck says he's putting lipstick on a pig over and over again. Yep, pretty much. Pretty much. His brain took a shooky dookie. Yep. The fact that he will not even talk directly to camera, he won't just look her in the eye and talk about it, says a lot. That he's just cowering. Like, I don't want to talk about it. It's not good. I don't want to talk about it. Yamaha Biker says, you'll have to excuse me. I keep trying to see that hot redhead and Bob keeps throwing shit over my screen.
I must say I don't have specifics about what Nelson is really after or what he will ask for.
Oh, you know what
I
he
will
wants,
say
Bob.
that, as is the case, has been the case in the past.
You know what he
management
wants.
Is always willing to listen to what
He
shareholders
wants
have to
your
say.
shower,
We're in lockstep
Bob.
with the board in terms of our
The shower
opportunities
in
and
your
our challenges
office.
and our
He
strategic direction.
wants
We all
it.
feel very optimistic about the future of the company. I don't have anything more to add really about that. Although I will say, in terms of your comment about our stock price, we don't manage the stock price for short-term gains or on a short-term basis. We have a long-term view. And in fact, this past year has been spent fixing a lot of things that needed to be addressed, either because of decisions that were made or because of the disruption in the business. We've accomplished.
Yeah, spent a lot of time this year fixing things. Yeah, you're going to hear the word fixing a lot on this and on the investor call. What would you need to fix there, Bob? Are there things that are broken in your company? Are those things that need to be repaired because they're broken? Because you broke them? You know, call me crazy, but that sounds like an admission of guilt.
I have spoken!
Yeah. Yeah, like how the iceberg fixed Titanic. Yeah, that is it. That is perfect, Buck. Yeah. Yeah, he's fixing Disney the same way the iceberg fixed the Titanic. Yes. Full credit there. JKD Buck, thank you. That is amazing. Yes. Awesome. I love that. Yes. Thank you. That's for you, buddy. That is perfection.
Accomplished a tremendous amount. We remain very optimistic, in part because of how much we've accomplished, but also because of the strength of our team and the strength of our assets. And so I think long-term, the picture for Disney shareholders is quite bright.
Now, you just announced a new CFO, Hugh Johnston, who has dealt with Ike Perlmutter and his activist actions in the past when he was at Pepsi. Do you think he'll help you in any potential battle with him?
We're first of all, we feel very fortunate to have been able to hire Hugh. I'm looking forward to working with him. He starts in a few weeks, and he'll be helpful to us in a number of different ways. I'm looking forward to.
Oh, I'm sure.
Certainly a lot of different financial changes potentially. You are doubling down on the parks. That's one big financial change. Announced that you're investing $60 billion over the next 10 years. Are you concerned about consumer spending waning, especially if there is not, say, a soft landing with this economy?
Well, if you look at our track record, particularly the last 5 years of the parks, but you can look back another, say, 10 years, it's been stellar in terms of return on invested capital. The investments that we've made in that business, just by the way, and domestically, but also globally, have really paid off. And they've each paid for themselves in many ways. And since we make decisions about it, capital allocation that are based on what we feel is the best way to deploy our money to deliver shareholder value, we felt in looking at the results of the parks that since the returns have been so strong, why not invest more? It was as simple as that. The trajectory is very bright for those parks. You can look at the results today and see that not only are domestic parks doing well, or we've got some difficult comparable or comparisons in terms of the Florida parks, but the international parks are doing extremely well, as is our cruise business. So when we looked ahead at how we'll allocate capital, and you mentioned the guidance that we gave about growing free cash flow in fiscal 24, we decided that a great place to place our bets or our capital is in the business that's delivered the best results.
Yeah.
We're not concerned. By the way, you look back, there have been all kinds of cycles in terms of the consumer, dating back to 2008, 2009, for instance, or 2011 with what happened with the terrorist attacks. And again, those are, I don't want to say blips because they're significant, but they come and go, and we've seen that. And we don't invest for any one specific time. We invest for the long term.
Well, before we're out of
Yes,
time, I
I
want to make
can
sure to ask you about
definitely
the
smell
strike. The
shite.
Screen Actors Guild is still on strike. There are picketers outside the lot where we are right now. From what I understand, there are negotiations happening perhaps even as we speak. And there's a lot of concern that if this actors strike drags on longer, it could really threaten the films at the box office. I know that your movie industry is a big priority to you. What can you tell us about the state of negotiations and how this could really impact your business?
Well, first of all, let me begin by saying I have the utmost respect for actors. They're an incredibly important part of the Walt Disney Company for obvious reasons. And we've been hard at work, we, the companies involved in this business, as well as SAG, the Screen Actors Guild, in trying to figure out a way to get them back to work. And I can only say that I'm optimistic that we'll figure that out relatively soon. In terms of the impact on the business, so far it's been negligible. Long term, meaning if the strike goes on much longer, it could become significant. Obviously, we'd like to try to preserve a summer of films. The entire industry is focused on that. We don't have much time to do that.
You think a week, 2 weeks before the summer?
I don't want to specify, except that we're all, SAG and the AMPTP companies, are very hard at work at trying to solve this.
Well, we hope
as we speak.
Yeah, as we speak.
Sure.
On behalf of everyone working here in Los Angeles, I hope that resolution is soon. Bob Iger, CEO of the Walt Disney Company, thanks so much for joining us here today at your headquarters. I know you have an earnings call coming right up.
I do, Julia. Thank you very much.
I'll send it back to you guys.
All right, and the call actually came like right after that. So,
No offense, but it sounds like some fucking commie gobbledygook.
that's pretty much how I felt about listening to all of this, like coming out of this. Yeah, new CFO is going to be a chef, and all his cooking will be of the books. Yep, I completely agree. All you have left is optimism, Bob. You can crap in one hand and wish in the other and see which one fills first. Oh, that is scathing. Yamaha biker absolutely being savage over here.
Emotional damage.
Love it. I love my chat. Y'all are amazing. Ms. K. Griff, hire who? Hugh, not me. Who? We're hired. Hugh? Hugh who? You, Hugh. Sorry, I'm heavily medicated right now. We all envy you. Oh, I'm so sorry for your strep there, Ms. K. Griff. I'm sorry to hear that, but hopefully the loopiness provides some euphoric benefit. As long as they're anything but straight and white, that is, yeah, okay, I get it. You big summer blowout. Phrasing?
Phrasing. Hey, phrasing. Phrasing, mother. Phrasing. Phrasing. Phrasing.
Oh my gosh. All right. So now that we got the It's like that out of the way. All right. So we're going to go over to the investor call. I'm going to, again, put that at 1.25 and change the audio just a little bit there. Hopefully make that a little easier. Okay. So, all right, here's where we're going to watch the investor call. It is almost an hour long. Once they get to kind of like the, the ancillary stuff at the end, I mean, we'll go ahead and probably cut out of that. So I would say maybe 40 minutes. Yeah, it's a lot of legalese. It's a lot of the usual kind of the corpo speak. So here is your giant flying warning in the sky.
Shit's about to get fucky.
So hang on. We're going to watch this. We're going to listen to it. And we're going to talk about it a little bit afterward. All right. There we go. And this is just video, or this is just audio. There's no video. Whoops. Okay. There we go. And we'll just go with that. All right, everybody, hang tight. We're gonna roll this.
Hold on to your butts.
Good afternoon. It's my pleasure to welcome everybody to the Walt Disney Company's first quarter 2023 earnings call.
And yeah, I'm gonna have to
Press
increase the
release was issued
volume.
about 25 minutes ago and is available on our website at www.disney.com.
Volume is at 600%, by the way.
Today's call is being webcast, and a replay and transcript will also be made available on our website. Joining me for today's call are Bob Iger, Disney's Chief Executive Officer, and Christine McCarthy, Senior Executive Vice President and Chief Financial Officer. Following comments from Bob and Christine, we will be happy to take some of your questions. We have a lot to get through today, but we'll do our best to answer as many questions as we can. So with that, let me turn the call over to Bob to get started.
Thank you, Alexia, and good afternoon, everyone. It's an extraordinary privilege to lead this remarkable company again, especially at this special moment in history as we celebrate our centenary. Since I first became CEO in 2005, I have guided the Walt Disney Company through two significant transformations. The first was to confer greater creative control and authority to our creative businesses and to focus on great brands and franchises. It was also aimed at embracing new technologies and expanding internationally. It ultimately led to the acquisitions of Pixar, Marvel, and Lucasfilm.
It's an investor call for a reason.
2016, we laid the foundation for Disney to become a true digital company. As we were planning to launch our streaming platforms, the opportunity arose to acquire numerous assets from 21st Century Fox. And that acquisition gave us a bigger library with more franchises, a broader global reach, and a talented, experienced management team that enabled us to generate even more higher quality content. In 2019, Disney Plus launched with nearly 500 films and 7,500 episodes of television from across the world of Disney. 3 years later, its meteoric rise is considered one of the most successful rollouts in the history of the media business. Now it's time for another transformation, one that rationalizes our enviable streaming business and puts it on a path to sustained growth and profitability, while also reducing expenses to improve margins and returns, and better positioning us to weather future disruption, increased competition, and global economic challenges. We must also return creativity to the center of the company, increase accountability, improve results, and ensure the quality of our content and experiences.
Okay, if you haven't already noticed, yeah, like I said, be prepared. This is a lot of corpo speak, but also, yeah, I realize it's very boring because they have a lot of just the kind of, it's the very measured, very sanitized, there's nothing new here. There's nothing that's going to be really like, there's not going to be any real fireworks. That's usually for, the beginning of the year, like fiscal year stuff. So we'll kind of keep an eye out. But yeah, this is just, this is all very well rehearsed. And yeah, they're talking off a script. That's just the way that things always go for these kinds of calls. At least until we get to the Q&A. The Q&A gets a little spicy, but you know.
Now the details. Our company is fueled by storytelling and creativity. And virtually every dollar we earn, every transaction, every interaction with our consumers emanates from something creative. And I've always believed that the best way to spur great creativity is to make sure the people who are managing the creative processes feel empowered. Therefore, our new
Yeah,
structure
right.
is aimed at returning greater authority to our creative leaders and making them accountable for how their content performs financially. Our former structure severed that link, and it must be restored. Moving forward, our creative teams will determine what content we're making, how it is distributed and monetized, and how it gets marketed. Managing costs, maximizing revenue, and driving growth from the content being produced will be their responsibility.
And by the way, again, if you notice that this is a little bit, this guy sounds very slow, remember, I've already bumped this to 1.25 speed, so it's actually faster than it was in real life. Listening to this live, whenever I did, like originally, yeah, it's kind of painfully slow.
Under our strategic reorganization, there will be 3 core business segments: Disney Entertainment, ESPN, and Disney Parks, Experiences, and Products. Alan Bergman and Dana Walden will be co-chairmen of Disney Entertainment, which will include the company's full portfolio of entertainment media and content businesses globally, including streaming. Jimmy Pitaro will continue to serve as chairman of ESPN, which will include ESPN Networks, ESPN Plus, and our international sports channels. And Josh D'Amaro will continue to be chairman of Disney Parks, Experiences, and Products, which will include our theme parks, resort destinations, and cruise line, as well as Disney's consumer products, games, and publishing businesses. These organizational changes will be implemented immediately, and we will begin reporting under the new business structure by the end of the fiscal year. This reorganization will result in a more cost-effective, coordinated, and streamlined approach to our operations, and we are committed to running our businesses more efficiently, especially in a challenging economic environment. In that regard, we are targeting $5.5 billion of cost savings across the company. First, reductions to our non-content costs will total roughly $2.5 billion, not adjusted for inflation. $1 billion in savings is already underway.
Yep, Yamaha, that would be right. I would agree.
In general, the savings will come from reductions in SG&A and other operating costs across the company. To help achieve this, we will be reducing our workforce by approximately 7,000 jobs. While this is necessary to address the challenges we're facing today, I do not make this decision lightly. I have enormous respect and appreciation for the talent and dedication of our employees worldwide, and I'm mindful of the personal impact of these changes.
Oh, wait, hang on a second. Oh, you gotta be kidding me. Did I get the wrong one?
Emotional damage.
We're supposed to be watching the Q4 call. This is the Q1. I thought it sounded different. I'm an idiot. Hang on, y'all. Oh my God, I cannot believe I just did that. Okay, thank God. They finally got the webcast replay up there.
Start pressing the star
Okay.
key followed by 0.
Got it.
After today's presentation, there will be an opportunity.
Good afternoon. It's my pleasure to welcome everybody to the Walt Disney Company's fourth quarter 2023 earnings call. Our press release was issued about 25 minutes ago and is available on our website at www.disney.com/investors. Today's call is being webcast, and a replay and transcript, as well as the fourth quarter earnings presentation, will all be made available on our website after the call. Joining me for today's call are Bob Iger, Disney's Chief Executive Officer, and Kevin Lansbury, Interim Chief Financial Officer. Following comments from Bob and Kevin, we will be happy to take some of your questions. So with that, let me turn the call over to Bob to get started.
Thanks, Alexia, and good afternoon, everyone. Before we begin, this week we announced that Hugh Johnston will be joining the Walt Disney Company as Senior Executive Vice President and Chief Financial Officer after 34 years with PepsiCo. It's great to have Hugh joining Disney at this important moment for our company. I'd also like to thank Kevin Lansbury, who stepped into the CFO role on an interim basis earlier this year and has provided strong leadership in the months since. Kevin is returning to his role as CFO of our Disney Experiences segment, and you'll hear more from him in just a bit. Now let's turn to the quarter. Our results this quarter speak volumes about the underlying strength of our company and the remarkable amount of work we have accomplished this past year. Q4 adjusted earnings per share nearly tripled over the prior year. And all three of our businesses, entertainment, experiences, and sports, saw significant increases in fourth quarter operating income compared to Q4 of fiscal 22. The thorough restructuring of our company has enabled tremendous efficiencies, and we're on track to achieve roughly $7.5 billion in cost reductions, which is approximately $2 billion more than we targeted earlier this year. Our new structure also enabled us to greatly enhance our effectiveness, particularly in streaming, where we've created a more unified, cohesive, and highly coordinated approach to marketing, pricing, and programming. This has helped us improve operating results of our combined streaming businesses by approximately $1.4 billion from fiscal 2022 to fiscal 2023. And we remain confident that we will achieve profitability in Q4 of fiscal 2024. And most importantly, our new structure has restored creativity to the center of our company. And we certainly know from our now 100-year history that nothing is more important or critical to our success. Indeed, our strong creative accomplishments helped drive impressive growth in core Disney Plus subs, with nearly 7 million added in the quarter. This reflects the success of numerous popular titles to hit the platform, including Guardians of the Galaxy Volume 3, The Little Mermaid, and Elemental, continuing the trend of our theatrical releases being some of the most watched content on Disney Plus. Key originals also performed incredibly well across all our platforms, including Ahsoka on Disney Plus, The Kardashians, which is now our most viewed unscripted Hulu original series ever, and the spectacular Korean original series Moving, which has become a breakout hit.
Sorry, but the fact that the Kardashians are directly being lauded as helping to keep Disney afloat right now. Okay, I'm sorry, but Walt Disney is rolling in his grave. Geez.
On our achievement this past year, are mindful of the fact that a lot of time and effort was spent on fixing, both contending with certain decisions made in the recent past and addressing the numerous challenges brought on by disruption and the pandemic.
Yeah.
And while we still have work to do to continue improving results, our progress has allowed us to move beyond this period of fixing and begin building our businesses again. As we look forward, we are focusing on 4 key building opportunities that will be central to our success. And they are achieving significant and sustained profitability in our streaming business, building ESPN into the preeminent digital sports platform, improving the output and economics of our film studios, and turbocharging growth in our experiences business. We have already made considerable progress on these 4 opportunities, and we will continue to move forward with a sense of purpose and urgency. I've articulated many of my thoughts about our strategic initiatives, so today I want to discuss in more detail these 4 building opportunities as we enter this next phase. First is turning streaming into a profitable growth business. and I'm pleased to say our recent performance solidifies that we are on that path. In the 4 years since we launched Disney Plus, which generated roughly 10 million signups in the first 24 hours alone, core Disney Plus subscribers have now reached over 112 million as of the end of fiscal 23, including the nearly 7 million we gained this quarter. What's more, our ad-supported Disney Plus products grew by approximately 2 million subscriptions in Q4 to a total of 5.2 million. In fact, more than 50% of Q4 new U.S. subscribers chose an ad-supported Disney Plus product. And over the past 6 months, these AVOD subs spent 34% more time watching the service. We have the best advertiser technology in the streaming business globally, and we have just introduced new tools that will make this an even more attractive platform for advertisers, much as we've done with Hulu. And speaking of Hulu, we were pleased to announce last week that we will acquire the remaining stake in Hulu held by Comcast, which will further Disney's streaming objectives. We remain on track to roll out a more unified one-app experience domestically, making extensive general entertainment content available to bundle subscribers via Disney+. That includes critical and audience favorites like Hulu's Only Murders in the Building, The Bear, Abbott Elementary, as well as titles from our extensive content library built over decades, including adult animation standouts like Family Guy and long-running hit series like 911, which is moving to ABC for season 7.
They're having to
Hulu
acknowledge
and Disney
Family
Plus
Guy on a
will
Disney
result in
earnings call.
increased engagement, greater advertising opportunities, lower churn, and reduced customer acquisition costs, thereby increasing our overall margins. We will launch a beta version for bundle subscribers in December, giving parents time to set up profiles and parental controls that work best for their families, ahead of the official launch in early spring 2024. Also, we have additional opportunities for improvement in our streaming business that will come from implementing stronger standards around account sharing, although given the timing of our planned rollout, we don't expect a meaningful impact until 2025. Now that we have realigned our pricing and marketing strategies, focused aggressively on getting the technology right, merged our creative and distribution teams, and restored creative excellence as our singular motivating priority with the content we create, we are bullish about the future of our streaming business. And as you consider the components and the future of that business, just imagine the opportunities that a further combined Disney+, Hulu, and ESPN streaming experience could offer us as a company and our consumers. Another core building opportunity is taking ESPN, which is already the world's leading sports brand, and turning it into the preeminent digital sports platform, allowing us to reach fans in compelling new ways and fully integrating key features into our primary ESPN offering. We're already moving quickly down this path, and we are exploring strategic partnerships to help advance our efforts through marketing, technology, distribution, and additional content. As we continue to develop our streaming business, the continued strength of ESPN relative to the backdrop of notable linear industry declines demonstrates the value of sports and the power of the ESPN brand. Overall, our domestic ESPN business grew in revenue and operating income in both fiscal 22 and in fiscal 23. This fiscal year also saw the network deliver its best overall viewership in 4 years and its highest viewership in the key 18 to 49 demographic in the same time period. ESPN viewership was up in each of the 4 quarters as well, maintaining steady success throughout the entire year. Across ESPN networks, the company increased its already industry-leading share of sports viewership in fiscal 23, and we continue to see stability in ad sales despite challenges facing the broader media industry. ESPN Bet will launch next week through our agreement with Penn Entertainment, and we're excited to bring sports fans this compelling new experience. Regarding our broader linear business, we continue to evaluate options for each of our linear networks with the goal of identifying the best strategic path for the company and maximizing shareholder value. However, our review of the business thus far has uncovered significant long-term cost opportunities, which we are implementing while continuing to deliver high-quality content. Speaking of which, I'd like to acknowledge the world-class journalists and producers at ABC News. Over the past few months, many have risked their lives to keep our audiences informed during relentless news cycles and made ABC #1 in network news for the 11th consecutive year. Next is the need to strengthen the creative output of our film studio, which generates value throughout the entire company. To achieve this, we are focusing heavily on the core brands and franchises that fuel all of our businesses, and reducing output overall to enable us to concentrate on fewer projects and improve quality, while continuing our effort around the creation of fresh and compelling original IP. I'm devoting considerably more of my time to this with the goal of improving returns, always seeking to exceed the level of creative excellence audiences expect from Disney. Meanwhile, we have 4 of the top 10 highest-grossing films of the global box office this year, including Pixar's Elemental, which has grossed nearly $500 million worldwide, in addition to being the most viewed film released this year on Disney+. We have more new releases still to come in calendar year 23, including The Marvels from Marvel Studios, which will be released this Friday, and Wish, our newest film from Walt Disney Animation Studios, which marks our company's 100th anniversary and will be in theaters beginning November 22nd. We're also looking forward to our strong theatrical slate in 24, with several films tied to popular franchises like Deadpool 3, featuring Wolverine, Kingdom of the Planet Apes, and Inside Out 2.
Kingdom of the Planet Apes?
Mufasa,
What?
The Lion King, and sequels from our Toy Story, Frozen, Zootopia, and Avatar franchises are all in the works. Finally, we have an opportunity to build Disney Experiences into an even bigger and more successful cash flow generation business. Parks and Experiences overall remains a growth story, and we are managing our portfolio exceptionally well. Even in the case of Walt Disney World, where we have a tough comparison to the prior year, when you look at this year's numbers compared to pre-pandemic levels in fiscal 19, we have seen growth in revenue and operating income of over 25% and 30% respectively. Over the last 5 years, return on invested capital has nearly doubled in our domestic parks, and we have seen sizable increases over that same time frame across the total experiences portfolio as well. Not to mention the improved guest experience ratings we're now seeing at every one of our parks. As we announced in September, we plan to turbocharge growth in our experiences business through strategic investments over the next decade. Given our wealth of IP, innovative technology, buildable land, unmatched creativity, and strong returns on invested capital, we're confident about the potential from our new investments. Looking at the company as a whole, today we are focused on driving profitable growth and value creation as we move from a period of fixing to a new era of building. We have a strong balance sheet, and we expect free cash flow to significantly improve in fiscal 24, approaching pre-COVID levels. Disney's Experiences business, with its expansive offerings around the world, is a key differentiator and remains a powerful growth engine, expanding operating margins by nearly 300 basis points over the past 5 years. As we transition ESPN to a streaming future and more fully integrate general entertainment content into Disney+, we will have a DTC offering unlike any other in the industry. And Disney's leadership and workforce around the world are second to none. When you combine all of that with our unrivaled portfolio of valuable businesses, brands, and assets, and the way we manage them together, Disney has a strong hand that differentiates us from others in the industry. Our results this quarter are a testament to the work we've done across the company this past year, and I'm bullish about the opportunities we have to create lasting growth and shareholder value, and to strengthen Disney's position as the world's leading entertainment company. And with that, I will turn things over to Kevin.
Thank you, Bob. I appreciate your kind words at the outset of the call. It's been an honor serving as interim CFO these past few months.
Oh boy, this
We are
guy
excited to welcome
sounds
you to the Walt
amazingly
Disney
interesting.
Company, and I look forward to working with both of you on all that's ahead. Now,
Oh, the suspense.
dive into this quarter. Diluted earnings per share, excluding certain items, increased versus the prior year to 82 cents in the fiscal fourth quarter and $3.76 for the full fiscal year. This past
talking
year
about
has been
some
marked by both
high numbers.
transformation and execution.
Almost $4.
We are pleased with the momentum we are building and the results we've realized, including meeting our guide of high single-digit percentage growth in both revenue and operating income for fiscal 2023. Total company revenues for the year increased 7%, and segment operating income grew by 8%, excluding the impact of accelerated depreciation from the Galactic Starcruiser. And free cash flow for the year increased substantially, totaling close to $5 billion, driven by the work we've been doing on the cost efficiency front and by improvements in our underlying financial results. A few weeks ago, we published our recast financials, aligned to our newly reorganized segment structure. Today, I'll be walking through the fourth quarter's financial results for each of our three segments: entertainment, sports, and experiences, and I'll also provide some color for the year ahead. Starting off with entertainment, Q4 operating income grew by over $800 million versus the prior year quarter, driven by improvement in our direct-to-consumer business. We continue to make headway on our path to profitability in streaming, with fourth quarter operating losses at our entertainment D2C services improving by nearly $1 billion versus the prior year, or $85 million sequentially to $420 million. Note that our entertainment direct-to-consumer results exclude ESPN+. Including ESPN+, our combined streaming businesses had an operating loss in the fourth quarter of $387 million, a year-over-year improvement of a little over $1 billion and a sequential improvement of $125 million. As Bob noted earlier, we added nearly 7 million Disney Plus core subs over the past quarter, reflecting strong content performance and our global summer promotion. Disney Plus core ARPU increased sequentially by 12 cents, driven by pricing increases and higher advertising revenue, partially offset by the impact of the summer promotion. The Disney Plus ad tier added approximately 2 million subs during the fourth quarter and ended the fiscal year with 5.2 million subscribers. We anticipate core Disney Plus subscribers in fiscal Q1 will decline slightly versus Q4 due to the expected temporary uptick in churn from the recent U.S. price increases, as well as from the end of the summer promotion.
Something I want to make a note of there. So something that just recently happened is that they reached a deal with Spectrum. So a lot of people that already may have had Disney Plus just basically got a full, like a brand new Disney Plus account because they bundled all their stuff together like onto Disney Plus. I'm not entirely sure, but that sounds like they may have accidentally inflated their numbers a little bit because every single month they have been hemorrhaging subscribers. How they suddenly went from hemorrhaging subscribers to a growth of 2 million, I have questions. Ms. Kaker says, this is how their executives are. I understand why most of them Most of their new stuff is so boring. Yeah. We're dealing with the bean counters here. We're not dealing with like, the energetic Wall Street folks. We're dealing with the literal bean counters within these major companies.
However, we expect to see sub growth rebound later in the fiscal year. Growth in entertainment D2C advertising revenue of 4% in Q4 versus the prior year partially offset linear ad declines. The growth reflects an increase at Disney Plus, while Hulu results declined due to lower political and technology category advertising. We continue to expect to reach profitability at our combined streaming businesses in Q4 of fiscal 2024. Although, as we have mentioned in the past, we don't expect linear progress from quarter to quarter. While we expect entertainment D2C operating losses in Q1 to be generally in line with Q4 due to higher sports rights costs at ESPN Plus aligned with the start of the NHL season, we anticipate a modest sequential decline in Q1 for the combined streaming business. But as we have also said previously, we anticipate upward momentum later in the fiscal year to be driven by realizing the full impact of price increases, the launch of the ad tier internationally, and subscriber growth. At Linear Networks, which now excludes our sports channels, fourth quarter operating income was flat to the prior year, reflecting lower advertising and affiliate revenues, which were generally offset by a decrease in marketing and programming and production costs. Advertising revenue declines were driven by our domestic business, primarily at ABC and our own TV stations. Domestic entertainment affiliate revenue decreased by 4% in the fourth quarter versus the prior year due to a 6-point decline from fewer subscribers and a 1.5-point adverse impact from the Charter blackout, partially offset by a roughly 4-point impact from higher rates. As Bob mentioned, we remain focused on driving additional cost efficiencies in this business over the long term. Content sales, licensing, and other lower operating results versus the prior year were due to lower.
Yeah, and I'm sorry, guys, I cannot speed this version of everything up. Otherwise, I would.
Results. We currently expect that first quarter operating income will be roughly break even and comparable to the prior year. Moving to our sports segment, Q4 operating income increased by 14% versus the prior year. Results were driven by our domestic ESPN business from lower programming and production costs, growth in subscription revenue at ESPN Plus due to both pricing and sub growth, and lower marketing costs, partially offset by lower affiliate revenue. The decrease in programming and production costs reflect the absence of the Big Ten. And domestic ESPN linear advertising revenue increased by 1% in the fourth quarter versus the prior year, despite the absence of the Big Ten, the Charter blackout, and a highly competitive marketplace. Domestic affiliate revenue decreased by a little less than 5% in Q4 versus the prior year, as 5.5 points of growth from higher rates were offset by adverse impacts of approximately 7.5 points from fewer subscribers and 2 points from the Charter blackout. As Bob referenced earlier, it's worth noting that ESPN's domestic business grew both full-year revenue and operating income in each of the last 2 years. These results give us confidence in our belief that sports has the power to drive value for the company, even in the face of challenging industry headwinds. Finally, at Experiences, fourth quarter operating results increased by over 30% versus the prior year quarter, and 27% versus fiscal 19. Operating margins at the segment were 22% in Q4, an increase of 3 percentage points versus the prior year. Our international operations continued their strong performance trend in the quarter with significant growth across all sites versus the prior year. Disney Cruise Line, Disney Vacation Club, and Disneyland Resort also all saw strong year-over-year growth in both revenue and operating income. At Walt Disney World, operating results decreased, driven by the accelerated depreciation from the closure of the Galactic Star Cruiser, along with inflationary impacts and the continued comparison to the 50th anniversary celebration in the prior year. Looking towards fiscal 2024, we anticipate robust annual operating income growth at Experiences to reflect continued strong performance at our international parks and Disney Cruise Line. While domestic parks and Experiences is expecting solid growth for the full year, that growth will be heavily back-end loaded due to continued challenging comparisons in the first half of the year from the 50th anniversary at Walt Disney World, in addition to wage inflation. We continue to be bullish on the long-term positioning of our Experiences business, as evidenced by a recent announcement on significant investments we plan to make over the next 10 years to turbocharge growth in this area. We expect those investments to ramp up towards the back half of that 10-year period, with more gradual increases in the first few years. As has been the case historically, CapEx for the parks are largely and effectively self-funded, given the strong returns these investments generate over time. And I would also note that a portion of the investments in our theme parks in Shanghai and Hong Kong is funded out of joint venture cash flows. Before we conclude and move to Q&A, there are a number of additional items I'd like to share for context on the year ahead. First, on capital expenditures. Fiscal 2023 CapEx totaled approximately $5 billion, roughly comparable to the prior year and in line with our most recent guidance. And we expect CapEx in fiscal 2024 to total $6 billion, an increase of approximately $1 billion versus fiscal 2023, driven by higher spend at Experiences. CapEx at Experiences in fiscal 2024 will look more comparable to fiscal 2019 levels and include spend at our cruise business ahead of the launch of 3 new ships in fiscal 2025 and 2026.
I don't know how they have the
Our
money for new
enterprise-wide
ships.
content spend in fiscal 2023 was $27 billion, in line with our guidance and about $3 billion below the prior year, as we significantly reduced our spend on entertainment content. As a result of our continued work to be more efficient in our content spend, in addition to impacts from the strikes and the timing of sports payments, we expect total content spend in fiscal 2024 to be approximately $25 billion, which is a decrease of $2 billion versus 2023. Note that sports rights now account for over 40% of our enterprise-wide content spend. Our annualized entertainment cash content spend reduction target is now $4.5 billion, excluding strike impacts and sports rights, versus $3 billion previously. We expect this to be realized on a cash basis in fiscal 2024, although it will take a few years for the bulk of these savings to be reflected in the P&L due to the timing of amortization. On the topic of cost savings and streamlining our operations, we have eliminated over 8,000 roles, and while we are not currently planning to make further large-scale reductions to our workforce, we are taking significant concrete steps to continue addressing the cost basis of the overall company. We have increased our annualized efficiency target for total company SG&A and other operating expenses to $3 billion versus $2.5 billion previously, including the strike impacts. Approximately $2 billion of these efficiencies were achieved in fiscal 2023. Naturally, we also saw inflation and volume-related cost increases throughout the year, including higher content amortization and costs related to expanded operations at international parks and cruise, which were impacted by closures and limited operating capacity in the prior year. The remainder of these savings are expected to be achieved by the end of fiscal 2024. Our expense base in fiscal 2024 is expected to only increase slightly versus the prior year, as these efficiencies and strike savings will mostly offset the year's planned volume-related growth and inflation. Adding the new $4.5 billion cash content spend reduction target to the $3 billion expense target brings our total annualized target to $7.5 billion, as Bob announced earlier. All of these factors, in addition to continued growth and improvement across our underlying businesses, are expected to come together over the coming fiscal year to result in free cash flow generation of roughly $8 billion, a significant year-over-year increase and approaching levels we last achieved pre-pandemic. This continued robust free cash flow growth, alongside our strong balance sheet, will position us well to address our investment and shareholder return goals for the year and going forward. To that end, we will be recommending to the board that they declare a dividend by the end of this calendar year. While this will be just the starting point, we do see ample opportunity to continue to increase shareholder returns in the future as our earnings and free cash flow grow in the form of increased dividends or share buybacks, and we look forward to sharing more as we move ahead. And with that, I will turn the call back to Alexia for Q&A.
Thanks,
Okay,
Kevin.
finally,
As we transition
we get to Q&A.
we ask that you please try to limit yourself to one question in order to help us get to as many analysts as possible today. And with that, operator, we're ready for the first question.
The first question will come from Michael Nathanson with MoffettNathanson. You may now go ahead.
Thanks. Hey, Bob, I have two quick ones for you. This is your first earnings call post the Charter Disney agreement. So stepping back, what are the most important impacts to Disney after that agreement? And then how will you manage the company differently now that that is kind of the template going forward for new deals? And secondly, on film studio, your first stint, you had the most amazing content cycle on film we've ever seen. So I wonder, what do you think is ailing the film slate this time around, and what are your priorities to fixing it as you lay out one of your top three priorities? But what are you doing in particular to fix the film slate going forward? Thanks.
Thanks, Michael. Regarding Charter, first of all, as we said when we did the deal, we think it's a great deal for us. Also think it's a great deal for Charter. It doesn't really change things much in terms of our strategy, because when you look at the deal, it actually ended up reflecting exactly what our strategic priorities are. That is streaming. And the distribution agreement for Disney Plus as part of the overall Charter deal does just that. So it leans into our streaming priorities, and that strategy doesn't change things much. Having the opportunity to consolidate a bit on the channel side is, I think, a good thing at this point. In terms of the studio, nice of you to mention just what our great run. First of all, let's put things in perspective. Recently, we did have 4 really strong titles, and 4 of the top 10 in the past year, led by Avatar, of course. But there were other successes too. That said, as I've looked at our overall output, meaning the studio, it's clear that the pandemic created a lot of challenges creatively for everybody, including for us. In addition, at the time the pandemic hit, we were leaning into a huge increase in how much we were making. And I've always felt that quantity can be actually a negative when it comes to quality, and I think that's exactly what happened. We lost some focus. And so working with the talented team at the studio, we're looking to and working to consolidate, meaning make less, focus more on quality. We're all rolling up our sleeves, including myself, to do just that. We have obviously great assets, great stories to tell from the assets that we either have or that we purchased. And I feel really optimistic about the slate going forward, which is going to be a balance between some really strong sequels to some very, very popular titles, as well as some good original content, starting with Wish, which comes out Thanksgiving weekend. So I feel good about the direction we're headed, but I'm mindful of the fact that our performance from a quality perspective wasn't really up to the standards that we set for ourselves.
Thank you. Next question, please.
Our next question will come from Stephen Cahall with Wells Fargo. You may now go ahead.
Thank you. So first on DTC, I mean, pricing is about to step up. You announced the cost-cutting program, some of which might be at DTC or Hulu. And Bob, I think for a couple of quarters, you've just been talking about how confident you are in streaming profitability. So I'm not asking for guidance, but is there any way for us to just frame what DTC can look like beyond break even, since that's really the biggest driver of earnings growth and value creation? And then on the ESPN side, just as we think about that, preeminent sports platform that you're looking to build, so many folks have already voted with their feet to be outside of the bundle. How do you think about putting something into the market more quickly, maybe at a high price point that doesn't disrupt the bundle, just to see if the cord cutters or cord nevers have some demand? Thank you.
I'll take the second part first. Our
I'm
plan
sure you
when
will,
we
Bob.
bring ESPN direct to consumer, which is inevitable, which is going to happen, and we're planning for it, is to try to have what I'll call a soft landing, which is continue to make it available as part of the bundle for those people that want to remain in the bundle or people who feel that the bundle still has value to them, and at the same time to make it available on a true a la carte basis in DTC form. So it is our hope that it will serve basically the consumer in two ways, in the traditional way and in a new way. And we'll obviously see in terms of where we end up in the blend of basically consumers that stay in the bundle and those that leave. We're not concerned about it. And actually, as we model basically ESPN into the future, we see that in some cases it will continue to be sold as part of the bundle. To the first question, the trajectory of DTC, we're not going to get specific. We're not giving any guidance beyond our guidance about becoming profitable at the end of 24. But the building blocks are in place to turn this into a real growth business for us. And the recent announcement about purchasing the remaining stake in Hulu is just one of those building blocks. On the pricing side, we did take Disney Plus prices up for the premium service, the non-advertiser supported, by about 27%. It's still really early to tell, but we had taken those prices up significantly a year earlier, and churn was de minimis. So we felt we had the room, particularly as we improved quality on the Disney Plus service. Where overall our strategy regarding pricing is more sophisticated, more coordinated across the world than it had been before. And as we look at growing that business, a smarter approach to pricing is one. Bundling is another. I'm going to come back to the bundle between Disney Plus and Hulu, and then the opportunity to bundle ESPN. Clearly, we've got technology improvements in the works, whether it comes to account sharing or whether it comes to basically lowering customer acquisition costs and churn and lowering marketing expenses and growing margins. That's part of it. Advertising is a strong component of that. We did not take pricing up for Disney Plus advertiser-supported services, and the delta between the advertiser-supported and the premium service is wider because we like the ARPU that we get basically from both sides. So we feel really good about the potential of this business. And look, if you think about the portfolio of streaming assets that we will have, Hulu, Disney Plus, and ESPN, that's a very, very strong hand. In December, we launched a beta version of Hulu and Disney Plus combined. We feel really good about that. I saw basically some demos of that just yesterday, as a matter of fact. We are basically putting it in beta so that we can prepare parents largely to basically implement parental controls, because you'll be able to access Hulu programming on the same app. And then in late March, we'll launch it basically in full form. And think we have opportunities in terms of upsell capabilities, in terms of increasing engagement. We found that where we bundle, we lower churn. And again, these are steps that are all taken to ultimately turn this into a great business. Lastly, in terms of cost reductions, we created basically a one-world approach to streaming. We had multiple organizations before. We now have one run globally by Dana Walden and Alan Bergman. They have created an entirely new senior management team across the globe to manage these assets. We're doing so much more cohesively, including, by the way, balancing spending in market, local spending, and what I'll call global spending. One thing that we have recently really come to appreciate is the performance of our big title films, the so-called pay one window films. on the service. Elemental is one, Guardians of the Galaxy 3 was another, Little Mermaid a third. The numbers are huge. That's a differentiator for us, certainly when it comes to competing with Netflix, for instance, which is the gold standard. But by leaning more into some of those films, and while we improve the quality of them, gives us the ability to dial back a bit on some of the spending and investment in series. And that blend of spending between films and series, we believe, gives an opportunity to increase our margins and grow the business.
All right, next question, please.
Our next question will come from Ben Swinburne with Morgan Stanley. You may now go ahead.
Thanks. Good afternoon. I want to come back to the free cash flow commentary because that's pretty interesting and new, and also ask you, Bob, about your U.S. sports business and ESPN. So on cash flow, $8 billion of free cash flow, $6 billion of CapEx, getting to $14 billion of cash from operations. You haven't done a number like that, I think, since 2018. And I'm just trying to understand if you think you can sustain and grow your company at that level of cash content spend. I think Kevin said 25, because that certainly allows you to really grow free cash flow from a base that's already higher than people were expecting in 2024. Hopefully that made sense. And then on the sports side, Bob, people think about ESPN as a network facing cord cutting, et cetera. You clearly have a vision there that you think can grow over time. Can you talk a bit about how you think about growing the sports business? Do you think you can, between linear and digital and other ancillary services, sort of grow your sports business over time? Because that would be another area where you'd certainly outperform expectations. Thanks so much.
I'll take the question about ESPN first. Interesting, I just saw statistics. ESPN is the #1 brand on TikTok. Not the #1 sports brand, not the #1 media brand, the #1 brand with about 44 million followers, which is an incredible statistic. ESPN is a very popular, in-demand product in the United States, and unique, we believe. And we feel leaning into it is the smart thing to do because of its unique quality, how popular it is, and how profitable it has been. We believe we have an opportunity there as we bring it in the direct-to-consumer direction to strengthen our hand when we do that by partnering with either tech companies that can provide us with marketing, technology support, customer acquisition help, or sports leagues that can provide us with more content. It's that simple. We're actually quite bullish about it. And frankly, if we were to just sit back and leave ESPN alone kind of as part of the linear bundle, we know ultimately where that would bring us. It certainly wouldn't bring us in a growth direction because of basically the continued decrease in multi-channel subscribers. So this is a way to really buck that trend, continue to allow it to be part of the multi-channel bundle. But
don't worry,
also
folks. We are almost done. We've only got about
basically taking a very
couple more minutes of
product,
this because I know part of it is just
and possibly
the legalese,
it
which we can
by
skip.
doing what I described earlier. It's that simple. And we think about the building blocks of the company, which right now we believe there are 4. One of them obviously is streaming overall. Another one we've talked about, which is parks and resorts and turbocharging that growth. The third I talked about earlier, which is returning the studio to basically a level of success that we became used to before the pandemic. And the fourth is turning ESPN into a preeminent digital sports platform. Kevin, you take the cash flow.
Yeah, Ben, with respect to cash flow, we do feel good about where we are ending up in 24 from a content spend perspective. And when you take a look at how we're getting to that year over year, lower content spend is clearly part of it, but the continued growth and improvement in our underlying business is also a huge component of that, as is the annualized efficiency targets that we have all implemented. So those things are driving a significant amount of year-over-year improvement in our cash flow.
All right, operator, next question, please.
Our next question will come from Jessica Reif Ehrlich with BofA Securities. You may now go ahead.
Thank you. Excuse me. Thank you. Bob, I was wondering if you could give us your sort of holistic view on advertising and what's going on I mean, we know money's going into like retail media networks and things like that, but how much can you as a company make up on AVOD versus what's going on with linear? And maybe you can give us your view on what is going on with linear for you. And then on India,
By the way, AVOD stands for Advertiser Video on Demand.
notably challenging market, consistent money loser. Can you talk about how, your view of kind of ultimately where that winds up? Do you own it? Do you JV it? Do you exit the market?
Jessica, first of all, in India, our linear business actually does quite well. It's making money, but we know that other parts of that business are challenged for us and for others. And we are looking, I'll call it expansively. I know I've said this before, it always gets me in trouble, but we're considering our options there. If we have an opportunity to strengthen our hand, it is, I think, now maybe the most populous country in the world, or maybe just still second to China and about to pass them. We'd like to stay in that market. But we're also looking to see whether we can strengthen our hand, obviously improve the bottom line. In terms of advertising, we are actually finding that linear is a little bit stronger than we had expected it would be. It's not back as much as we would like. It's still challenged, but it's not as bad as it had been. So we've seen some slight improvement. Actually, the tech sector is still somewhat weak. But in general, overall, advertising has improved. We're finding, obviously, great demand for addressable advertising. I noted on an interview I did earlier that we've now put tools in place, or we're using tools in Disney Plus to provide advertisers with better targeting. They're starting to work. And in general, sports has been very, very strong. So as we look at the advertising marketplace right now, while it's not as strong as we would like it to be, it's certainly not as bad as some people think it is. And it's working for us. On AVOD, look, it's very, very clear that the tools that the new platforms provide advertisers are exactly what the advertisers are looking for. Those platforms are an advertiser's dream. And we know that the more data, the more detail the more context, the more targeting we can provide, the better off we'll be. Hulu had an extremely robust advertising engine. We've got one of the best in the business, if not the best. And so actually that combination of Hulu and Disney Plus with some of the tools that we put in place is going to give us the ability to have a blended CPM, grow engagement, grow advertising. So we're quite bullish about our position media-wise in an advertising marketplace.
Operator, next question, please.
Our next question will come from John Hodulik with UBS. You may now go ahead.
Great, thanks. Maybe first a follow-up to Ben's question. Bob, is there an opportunity for ESPN to add local sports rights, given what's happening to the RSN model, or potentially add sports rights to be distributed outside the U.S.? That's the first question. And then second question is, Warner Brothers basically made some news recently by licensing some of their what would be considered some of their tentpole content, their DC universe, to Netflix. Is that something you think that Disney can do or can lean into more, at least more so than you're doing now, without diluting the Disney brand or the Disney Plus growth prospects? Thanks.
Good questions, John. Thank you. We've actually been licensing content to Netflix, and are going to continue to. We're actually in discussion with them now about some opportunities, but I wouldn't expect that we will license our core brands to them. Those are real, obviously, competitive advantages for us and differentiators. Disney, Pixar, Marvel, Star Wars, for instance, all doing very, very well on our platform. And I don't see why, just basically to chase bucks, we should do that when they are really, really important building blocks.
Hold up. Bob Iger just said it's not our job to chase bucks. The CEO in charge of Disney, a for-profit company, just said it is not his job or Disney's job to pursue profit. I'm not kidding. That is what he just said, is that it is not their, he said it is not Disney's job or our job to chase bucks. That means that he is saying it's not their job to chase profit.
You stupid.
Oh my God. I can't freaking believe this. All right.
The current and future of our streaming business. Regarding local sports, the technology that we will have for ESPN DTC will give us the ability to provide local sports in a pretty robust way, basically what the RSNs are doing. But we're not really aiming to do so by taking on significant risk. So if we can find the right kind of business arrangements and partnerships, I think we'll look very seriously at providing local sports as part of that platform. But again, not if it results in us taking on too much risk.
All right, thank you. Operator, we have time for one more question.
Our final question will come from Phil Cusick with JP Morgan. You may now go ahead.
Hi, guys. Thank you. Bob, first follow up on ESPN, clearly a big priority. Can you give us some update on types of potential ESPN partners and what the hurdles might be to get those partnerships announced? And then second, maybe if you could dig into the recent trends of parks. There's been some noise on pricing, but what have you seen from consumer demand, both in Orlando and around the country? And how do you think that Walt Disney World is doing versus the overall Orlando market? Thanks very much.
The first question.
First question was on the conversation with Mr. T.
Oh, thank you. Sorry, Phil. I was listening to your second question. I forgot your first one. Senior moment. What basically we've been saying and what we've been exploring is that as we prepare to take ESPN in a direct-to-consumer direction, we believe that we have opportunities to strengthen our hand with entities that either provide us with technology, marketing support, for instance, or companies or entities, I should say, that can provide us with more content. We feel we have an excellent hand, by the way, and could do it without that, but why not explore strengthening our hand? And so since I noted that we were interested in this back in July, we've engaged with a number of different entities. I can say that there's significant interest out there. There are obviously complexities to it, but not complexities that were not hurdles that are so high that we can't jump over them. And we're going to continue to explore it, and I would imagine we'll have more to say about this in the coming months. But I don't want to say much more right now, except again, there's serious interest out there, and I think there's a path or paths to deals, but we're working through them, and obviously, as soon as they're completed, we'll let everybody know. You want to take the consumer demand question?
Yep. So with respect to the parks, and I think we talked about it in our prepared remarks with respect to Walt Disney World, and just we're lapping the 50th there. So we're going to continue to have a little bit of that lapping effect that will continue for a little bit as we go through Q1. But as I look out at the other domestic businesses, especially, Disneyland continues to look exceptionally strong, as does Disney Cruise Line. So bookings at all of those continue to be very, very strong going forward. So domestically, we feel good, and internationally, we feel pretty good. So we're not really seeing anything in terms of an economic hangover.
Thanks, Kevin. Thanks, Bob.
Okay, thanks for the question, and I want to thank everyone for joining us today. Note that a reconciliation of...
Okay, so yep, that is the end of the earnings call. Yep. That is all she wrote there. Okay. Yeah, I know. That was very dry. And, you know, for anybody that's on the replay crew, I'm so glad that you guys can speed that up, because I really didn't want to have to sit through all that, but oh God, I had to just to be able to say that we did. Okay. All right. So we do have some of that information. So now, after everything that's been said and done, okay, we have to ask. All right, Disney has been in some serious trouble here for a while. They've had a lot of things going on with just all the usual, just a lot of the usual kind of talk about what is happening inside their sphere of influence. The question has really been what is going on with Bob Iger. He doesn't look like he's as well put together as he has been in the past, and a lot of that likely has to do with the current situation inside Disney regarding Ike Perlmutter and Nelson Peltz having a serious bone to pick with Bob trying to go ahead and make his move for a hostile takeover of Disney. So to kind of get into this one, Disney's board is in focus as activist investor Nelson Peltz considers his next move. This is just posted actually today at 7 a.m. It was updated at 4:08 p.m. today. Now, yeah, as right now, is like Peltz was apparently waiting to see what Disney reveals in its quarterly earnings Wednesday before making his next move, according to sources. So, what he plans to do, we will probably know in the next couple of days, as he basically has now heard this and he formulates his plan going forward. But yeah, you just kind of know that for Disney right now, that's going to be it's going to be tough. Company boards tend to want to stay out of the spotlight. Okay, I'm just going to skip past that. So, yeah, Peltz's Trian Management Fund has oversight of about $2.5 billion of Disney shares. That is like almost 30%, I think. And we'll be paying close attention to Disney's fiscal fourth quarter earnings report after the bell on Wednesday. According to people familiar with the matter, the majority of the shares controlled by Trian belong to Perlmutter, the former boss of Marvel Entertainment and a Peltz ally who has clashed with Disney chief executive Bob Iger in the past. Yeah. That is, yeah, that's a serious issue. So they mention here that Disney has cut 7,000 jobs. There was also some information that came out that actually the number is over 8,000 right now, and looking like they are probably going to have to still cut more. Yeah, and if that earnings call was any indication, they're really banking on ESPN to really kind of drive growth and sales. And look, I get it. Sports are sports, and they're big. They're always big. But I don't see this actually tracking towards any kind of like major profit boon, especially when they're the forward face of their company. When you think Disney movies, what they're putting out in theaters, what's going on the screen. And I'm just being honest, nobody gives a rat's ass about what's going out on screen right now because there's just everything that's coming out is shit. And if we want to talk about shit that's going out on screen right now, all we have to do is go over and talk about the Marvels because we got a major update on the Marvels today. So originally, from what we were hearing, the Marvels was aiming for a $60 million debut. It was originally around between 50, 55. Variety reporting 60 million. Well, actually, what's interesting is that what's now being reported, what we're actually looking at here is significantly lower. Even Deadline is trying to spin this, saying that Marvel's with a $140 million global opening, not expected to be marvelous at weekend box office. But even they're sitting down here saying that, it's, coming out saying that it's was projected 60 million. Some tracking services such as Quorum have lowered their estimates to 50 million. The Marvels opens this Friday. Well, I've got even more bad news for you in that case, because now we actually have some numbers. Now, Box Office Pro is who I trust for a lot of like big numbers and information as to what's going on. So their current projection was originally about 50 to 60 million. Now their projection is $42.2 million for opening weekend. 3-day forecast, which if this movie does that kind of numbers, if this movie does not break 50 million, okay, that is a major issue. Seriously. Ant-Man and the Wasp: Quantumania was what was really a big disappointment this year at the box office. The Eternals is still technically the worst MCU opening ever, and it had about about 60, I think 61 million for an opening. The Flash, which is at this point the worst performing movie out there in superhero history, with only a $55 million opening and a comparable budget to the Marvels, 55 million. They are projecting right now that the Marvels is projecting 42.2 million in its 3-day run at the box office for the domestic run. With international, I'm thinking that could probably be 60 to 70 million, but I don't think it's going to get nearly any higher than that. We could be looking at a movie that has a Marvel movie, an MCU movie that has an opening that is less than $100 million. That has never happened before. Fall Storm couldn't happen to a nicer bunch. Yeah, I know, right? I am dead serious here. This is looking bad for the Marvels. They cannot afford this kind of smoke right now. So going back over here to Deadline, overseas projection for the sequel sit at $80 million, putting the global start at $140 million, which is lower than the worldwide debuts of the Eternals at $160 million, and the theatrical day and date impacted Black Widow, $148 million. We're cautious that the international could come in lower. Yeah, again, as I was mentioning there, I'm pretty sure that is going to come in lower than what they're expecting. I would be completely honest. I don't think this movie overseas is going to do anywhere near as good as they're expecting it. Currently, where is it? Currently, there are box office numbers from China, and they're absolutely atrocious. Let's see here. Yeah, China opening with approximately 15 million or thereabouts. I fully expect that to be lower. Pre-sales for the Marvels sit just north of $5 million, which is on par with Warner Brothers DC's The Flash. That movie flaming out with a $55 million start stateside. Yikes. The worry is that if it previews, which started at 3 p.m. on Thursday, come in around 6 million, the Marvels weekend would crater with 40 million plus. Yeah. We'll see how things are on Thursday whenever the previews come out, but I'll be completely honest. I've been looking around. I saw that Yellow Flash put out there that they were asking people to go online to where the pre-sale tickets are for the Marvels and screenshot what their theaters were looking like at screening times. There is no seats almost that are actually going forward with. I mean, there's almost no seats bought in these theaters. This movie's going to crater. Look, I know that, if you've looked at the comment section on any of my videos lately, especially with the stuff about anything Marvel or MCU related, there are a lot of people that have either basically been, giving me shit and saying that my videos suck or my thumbnails are awful, or saying that I'm just some anti-woke some anti-woke grifter, or even some people just people just trolling because they're mad that I have opinions on things. Okay, well, first of all, get your own damn YouTube channel. Second of all, I kind of love the fact that these people are absolutely just getting haranguing on me when I'm like, look at the damn numbers. The numbers are right here. Seriously. If you're mad at me, you shouldn't be mad at me. You should be mad at the people who are making these decisions, that are making this crap that is not actually doing well. Fine if you enjoy it. I mean, enjoy whatever the hell you want. I mean, that's fine. You do you. But don't expect every single person in the world to like exactly the same thing that you do. Just saying. And the fact that when released to such a wide audience as these are, these general audience motion pictures, if people are not going to see it, then you know that these movies suck. People don't like them. They just don't care. As it is, I mean, with the Marvels, I mean, it used to be like if you saw like an MCU movie, you only really had to see the previous MCU movie to really kind of catch any inside jokes or anything that was going on. That's not bad. That's fine. If there were any inside jokes at all. And then suddenly it became okay, they had a few jokes here and there from series like Agent Carter, that kind of stuff. And okay, fine, fun little Easter egg, but you don't have to have seen the show to know what's going on. Right now, we get to a point where, in order to understand everything that happens between the Marvels, or between Captain Marvel and Marvels, you have to have watched Infinity War, Captain Marvel, Endgame, WandaVision, Loki, pretty much all the movies that have happened, movies and Disney Plus series that have happened between those movies and now, to understand what is going on in this friggin' movie. All in all, I think somebody tabulated it up that with the new Loki series, it came out to somewhere over 20 hours of content that you would have to go back and watch just to understand what the fuck is going on in this stupid movie. Yeah. I am not kidding about that. And yeah, because I have to bring this up. Yeah. I have to bring this up for a reason, because Disney executives are reportedly butthurt over South Park joining the Panderverse special. Yeah, why are they bringing this up? Why am I bringing this up? Well, I happen to be bringing it up for a very specific reason. Because of this line right here. In a Hail Mary last night, Marvel dropped the final trailer. They dropped the final trailer for their movie only 2 days before the movie. See below. Trying to connect the Marvels back to the greater Avengers canon and stunting a cameo in the pick by Tessa Thompson's Valkyrie. Yeah. So, again, like he says, in a Hail Mary last night, they dropped the final trailer and they spoiled a cameo by Tessa Thompson's character.
Put another gay diverse woman in it. Make it more fucking lame.
Exactly. It's what they fucking did. I can't believe this is real. Because we all know about that character. Yeah. I mean, seriously, Disney looked at exactly what was going on with their current slate, with their looking at what's going on with the Marvels, and they're like, shit, how do we save this untenable situation?
Put a chick in it, make her gay. Put a chick in it and make her name it gay.
Sure, yeah. Well, let's try that again.
Volstorf says, I can't watch Loki. I watched season 1 and it was awesome. Oh, okay. Because heaven forbid you have a dissenting opinion based on your own experience. Yep, pretty much. Yeah. Say, can't watch Loki. Watch season 1. So confusing. Yeah, the whole multiverse thing really is the whole multiverse thing and multiple timelines adding into it is just kind of like, oh god, why? So yeah, after we get down to that, so get down to this, so what's going on? Yeah, now we play the blame game. What's going on? Yes, blame the actors strike and Disney's hands being tied when it comes to fully screaming this movie to the sky. But at the same time, there wasn't any outdoor signage for the movie at San Diego Comic-Con. So how to tell the core fan base about an event? Oh, well, again, I have to point out this news article from the very beginning of our show. The strike ended. Yeah, the strike is over. Hollywood strike is over. The actors have agreed tentatively to a 3-year contract. Has yet to be ratified, but yeah, the studio said, okay, we're fucking tired of you people. Come to an agreement already, figure this shit out, and let's get back to work. If you don't, we're just going to say peace out, bye, and leave you all to rot. And they came back, said a couple hours, like 3 hours later. If you look at the time difference between these articles, this one was published at 4:01 p.m. This one saying the strike is over happened. Okay, this came out, like, whenever I saw it come out, it was like at like 8 o'clock. Yeah, strike is over. Yeah, so it took them about maybe not even 4 hours to come back and go, okay, yeah, we just need to get back to work and agree to this already. That's hilarious. All right. So, yeah. And again, I've been telling people since day one with regard to the Marvels. If you want to look at exactly how bad this movie is going to be and look at the failure, just look at what is going on right now with this movie and all the advertising. What little advertising they can do, considering that the actors and actresses are not able to promote it right now because the strike. But yeah, everything that we've heard about this movie in the interim, honestly, I think that the lack of people talking about this movie has actually helped the movie. I'll be completely honest, because now that we're actually getting information and hearing about it, suddenly I'm like, yeah, this sucks. Yeah, Marvel's director Nia DaCosta brags about film's representation behind the camera. Oh yeah, let's brag about diversity and diversity and all these like representation things immediately. Yeah, and just to kind of make sure everybody remembers this little tidbit here. Nia DaCosta, the director for the Marvels, left production of the movie while it was in post-production like 3 months before the movie was even done. Now, her defense, of course, is that Oh, well, I had like other prior commitments and everything, and I had to take care of those. Okay, ma'am, you were the boss. You were the director on a movie. Delays aside, that movie went into post-production, and you left the movie with 3 months left to go on this production, and you moved to London and started working on another movie. Pardon me if that rings a little bit insincere. Just saying. Yeah. So these articles started dropping that she left the film's production and showing some questionable morals, I'll say. Marvel's director Nia DaCosta endorses murdering one individual to save another, or in order to save many. Yeah, okay, in Minecraft. But I'm just saying, yeah, the Marvel's director Nia DaCosta endorsed deleting one individual in order to save many, while clarifying her comments about putting the blame on Captain America and Avengers Infinity War. Back in 2021, DaCosta gave an interview to Inverse where she put the blame for Thanos achieving his victory in Avengers Infinity War firmly on Captain America. When she asked, quote, she was asked, quote, when you were doing press for Candyman, you noticed that the racism tended to make people unaware, or make people unwilling martyrs, which is so very true. Oh God, we see it all the time, and superheroes are often unwilling martyrs, even though they're vastly different circumstances. Do you see any connection here? Yeah, just setting her up there. DaCosta responded, oh, wow, I didn't think about it in that sense, but I think Candyman especially is the way that we shifted his lore a bit in my film, He is a Hero. Of course, because you make them, the deleting psychopath, the hero in your movie. Yeah, that's a great idea. She then commented on Captain America and the snap. Quote, something I like to say a bit flippantly about Captain America is that the snap is all his fault because he was trying to do his best, trying to do the right thing. There is a world in which he's a villain because at the end of the day, he should have just sacrificed Vision. What?
What? What the fuck?
I mean, I'm sorry, my brain just did another collective. What? Something I like to say a little bit flippantly about Captain America is that the snap is all his fault because he was trying to do his best, trying to do the right thing. There's a world in which he's a villain because at the end of the day, he would have just sacrificed Vision. Saying that Captain America is that the snap is all his fault. The snap is all his fault because he was trying to do his best and trying to do the right thing.
What you just said is one of the most insanely idiotic things I have ever heard. At no point in your rambling, incoherent response were you even close to anything that could be considered a rational thought. Everyone in this room is now dumber for having listened to it. I award you no points, and may God have mercy on your soul.
Yeah, with morals like that, I mean, what do we expect? Out of this absolute moral exemplar of Captain Marvel, then. Yeah. But hey, guys, you know, at the end of the day, you think that, there's one man at the top of all of this that could fix everything. And that man's Kevin Feige. And literally yesterday, there was a rumor floating around that Kevin Feige is looking to leave Marvel for Star Wars following Avengers Secret Wars. Yep. Kevin Feige is looking to leave Marvel because it's already going down in flames and go to another place that has already gone down in flames and to what, make it worse? Well, thankfully, we found out that that's not actually happening. Yeah. Kevin Feige says his previously announced Star Wars film is not happening. Yeah, Marvel Studios boss Kevin Feige made it abundantly clear that his previously announced Star Wars film is no longer happening. While promoting the Marvels in Las Vegas, Feige was asked by the Entertainment Tonight's Ash Crosden, "What's up with a Star Wars movie? Is it happening? Is it happening?" Feige responded, "Any Star Wars movie?" Crosden then clarified, "Yours?" Feige then bluntly stated, "No." Kevin Feige produced Star Wars was announced back in 2019 by Alan Horn, who told The Hollywood Reporter, quote, "We are excited about the projects Kathy and Lucasfilm's team are working on, not only in terms of Star Wars, but also Indiana Jones and reaching into other parts of the company, including Children of Blood and Bone with Emma Watson Fox," unquote. Horn added, quote, "With the close of the Skywalker saga, Kathy is pursuing a new era of Star Wars storytelling, and knowing what a die-hard fan Kevin Feige is made sense for these two extraordinary producers to work together on a Star Wars film together," unquote. That's not happening now. Just gonna go ahead and say it there. All right, folks, your daily reminder that Marvel is absolutely in shame, or is falling apart. Disney is crumbling. Lucasfilm and Star Wars are already dead. At this point, it's just beating a dead horse. And the further proof is in the pudding when you consider the current numbers going into this weekend. I will keep you all posted. I will watch these very carefully, and I will keep an eye on things as things develop. But I will be completely honest with you. I have a feeling that this movie, The Marvels, has the potential in the same year as The Flash to unseat The Flash as the worst comic book movie ever made. It's entirely possible that this could happen. We could see it in the next few days. So keep things posted right here to Kaiser Pineapple. I will keep you all up to speed on the latest and greatest in all entertainment news. Everybody out there, thank you all so much for watching. To my chat, I know things got really boring there with the investor call, but I wanted to make sure that we did cover it and talk about it, because it is, as boring as it is worth noting. It is worth making sure we understand what's going on and getting that information out there. To everyone out there, thank you all. Please definitely, if you got a second, please go down there, hit that like button. If you're new here, hit that subscribe button. If you want to directly support the channel, there is the super chat feature, as well as there is for those on the replay crew, there's the super thanks. You can leave a tip in the tip jar. And, you can always feel free to make a donation directly to the channel through my link in the made page. There's a link there to my Cash App. It is not required, but it is always appreciated. I seriously appreciate every single one of you, my members, to my folks that are just regulars dropping in, to you new folks finding my channel for the first time. Thank you all. Have a great evening. I will see you all tomorrow, 9 p.m. Eastern, for The Edge of Reality, The Phoenix Lights. So get ready for that one. It's going to be a wild, wild time. Have a great night, folks. Peace.